Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Small cap investing, active versus passive. A very interesting data point that came out today said that all the small cap mutual funds have underperformed the small cap index. Firstly, there's too much money that's going into the small cap index. Indexing is seen as safe. While I think that indexing can be safe in certain products, in certain parts of the market, indexing in small cap is not really safe for the simple reason that stocks are illiquid. Once a fund finds its way into the small cap index, it's very easy to force a lot of people to buy it. So there is an incentive for companies to be maneuvered into the small cap index, and I see a lot of companies come into the small cap index through manipulation. So once a company comes into the small cap index, everybody is forced to buy it, especially those who are into indexing. So the indices keep on buying these stocks. Generally, go and have a look at the floating stock in small cap companies that came into the index in the last 1 or 2 years, and you will understand the problems with index investing in small cap. Illiquid stocks are being brought into the small cap index, and then retail investors who do indexing are buying those stocks by proxy. Evidently, exits could be given to people who have already consolidated the public float in the small cap companies. They get an easy exit because they are selling to the index funds, and the prices are going up continuously. So people are pouring money into the index funds thinking it's a safe method. And in this process, look at what the fund manager of an active fund may be doing. He may be actually staying away from a lot of these companies, and as a result underperforming the index. This is a very peculiar situation. It's ironic too. But investors today need to make a sensible judgment whether blindly putting money at elevated valuations into a very volatile part of the market like small cap makes sense. You also have to ask yourself whether it is safe for your capital to be invested in this manner. Now, it's another matter that one should not invest aggressively in actively managed funds as well. That's also the case. But the argument that active guys lost to the index does not hold water in this case, because the whole space itself needs to be viewed with suspicion and caution. I have been extremely cautious on this space. I have been closely observing what is going on in the trading in many of these companies, which are finding a prominent place both in actively managed funds and obviously in the indices as well. Because if you are in the actively managed fund, you are going to be in the index as well. There is another angle to this, that is, for the sake of liquidity, a lot of active managers have been buying liquid large cap companies like HDFC Bank in the small cap funds, and these are underperforming tremendously. So on the one side, the guy who buys, let's say, HDFC Bank in a small cap fund for the sake of liquidity underperforms, while the guy who buys a very frothy, overvalued small cap company that's just come into the index in the last 1 year through indexing looks like a smarter investor. Now, this is something that you need to think hard about, because investing in small cap must always be done with lot of caution and with a sense of responsibility. Ironically, indexing, which is supposed to be simple and not so irresponsible way of investing, turns out to be exactly the opposite when done in the small cap space. And that's something that we need to remember before we put more money into small caps. That's the message that I take from this comparison. Thank you for watching this video.